private equity, the lucrative business model with a market value in excess of $4.74 trillion. The life's mission of every finance bro in the world. The business model that's created more billionaires than any other single business model. The fabled Grim Reaper of business. But what the hell even is private equity? And what the hell do these people even do? Well, today on Business Capped, we're gonna find out. In short, a private equity firm is any investment firm that specializes and targets privately owned businesses that typically aren't listed on public markets. When you hear politicians or angry people on the internet talking about the sinister billion-dollar corporation buying your favorite toy store, closing it down and gutting it for cash, the idea of blaming it all on private equity is pretty unspecific and doesn't actually narrow things down. That's because they're talking about a special type of private equity firm known as a buyout fund. These are firms that take investor money and buy out entire companies. A lot of the time they'll do this by getting investor money together, finding a company or companies to buy, and using the businesses themselves as collateral and the cash as down payment to buy these companies, the same way you might get a mortgage on your house. This use of debt is known as a leveraged buyout, and another clever little way these people get stinking rich and are able to leverage debt to make more money. Of course, if you wanted to get a loan like this, you'd have to go to the bank and show that the company you want to buy has strong, consistent cash flow and is profitable. They'll do this purchasing in hopes of organizing the companies, making them more efficient and profitable by cutting out supposed junk, which to them is simply firing people, cost minimizing, profit maximizing, and revenue maximizing. Cutting costs wherever they can, growing the company in enterprise value, and selling it later down the line after making eye-watering returns. That's their game, and if that isn't gonna work, then well, these firms are gonna get their paper no matter what. They're prolific at it, relentless. One of the ways are by gutting these companies for what use they still have, be it real estate holdings, intellectual property, or whatever else, before letting the rest of it die. Or by saddling the company with shed loads of debt, by borrowing money to fund dividend recapitalization right into the PE firm's pocket. The reason this model makes people so stinking rich is because of how easy it is to make millions from it. If you can successfully start and run one of these firms, you'll probably become a billionaire. These firms are particularly designed to generate as much money as possible from buying entire private companies. If you decide that this is going to be your moneymaker, here's how you might do that. First, you need a corporate structure, something that's intentionally overcomplicated in order to protect you and minimize all the risks and downsides associated with starting your own firm, and also to help you navigate all those pesky financial regulations. You'd open a limited partnership, preferably doing the research on the best place to set one up, maybe somewhere like Delaware. You'd name yourself the general partner in order to cement yourself as the firm's big daddy, the man or woman in charge. In this position, you now have the ability to manage day-to-day operations and make critical decisions regarding your firm. The LPA, or Limited Partner Agreement, is your next crucial part of this corporate structure, as it outlines all the little terms and conditions between you, the general partner, and your limited partners, typically your other investors. The LPA is the rule book of your firm. It dictates allocations of profit and loss, investment strategies, and it ensures clarity of the rules. It outlines how much power and responsibility you as the general partner would have. If you try to give yourself too much power, investors would probably be turned off and not give you any money. And if you give yourself too little power, you'll end up having no control and being a little bit, which will likely prevent you from actually being able to run your own fund effectively. This structure should seek to protect you and the other partners and provide a stable framework for fund management. Once you've done this, here comes the networking. The favorite skill and the obsession of every business bro. You need to get investors on side and convince them your fund is worth a damn. Remember, all the people you try to bring on board could probably make these investments without your dumbass, so you need to really convince them that somehow you're going to make them even more money after you've deducted your expensive fees than they otherwise would get just making the investment on their own. Most private equity firms have a fee of around 2% of all funds being managed, and this exists to manage the expenses of the Harvard and Oxford Business School MBA analysts on their payroll, making fat six-figure salaries apiece, and to give you as the general partner a cheeky slice of bread yourself. Not a whole lot, however, that 20% is where the real cash comes from. 20% of all returns above a pre-agreed upon rate, known as a hurdle rate, will be paid to you as a bonus. A hurdle rate is the minimum rate of return a project or investment must achieve to be deemed acceptable to investors or managers. So if your fund has a hurdle rate of 15%, meaning you promise investors a 15% return on investment, and by the grace of God you pull out a 25% return, 20% of that additional 20% is all yours, incentivizing your fund to make some money. You're also incentivized to get a bigger pile because a bigger pile means more cash, which is even cheekier. That means your main job is to gather investment. The best way to do this is to put your money in first. If you're not already a centimillionaire with tens of millions to invest, your own money probably won't be enough to acquire entire companies, but it still does something very important. First of all, it shows investors that you're quite literally willing to put your money where your mouth is and take good care of their money because your money is also in the pile. The second part, and the best part, is that putting your money in means you get a cheeky little tax loophole by claiming whatever profits you make are capital gains and paying a lower tax rate than most others who pay income tax. But more on that later. Normally, investors won't be interested unless you already have industry connections and experience in the world of private equity and finance. But never fear, because if you have experience in a particular industry like, say, toys, you could start a private equity firm that specializes in acquiring toy stores, and all of a sudden investors are excited again. If you can provide consistently high returns for long enough, investors will line up to give you money to the point you'll have to tell some of them no. But until then, we have to start small. However, focusing on one industry can pigeonhole you, because if you try to then buy a hotel, investors could potentially sue you for violating the terms of your limited partner agreement, assuming it was in paper that you can only buy toy stores. That, and you have no clue how to run a hotel. You and your trusty analysts will also have to work with investment bankers to find deals on toy stores, as investment bankers are pretty much the realtors of selling private companies. Once you've found a deal, it's purchasing time. If your fund was able to raise, let's say, 100 million, and the company you're eyeing up is 100 million, you're essentially gambling the entire firm's cash pile on one deal. And if you know anything about investing, you know that isn't very smart. However, using the trusty leveraged buyout approach, you can put down, say, 20 million and borrow the remaining 80 million, assuming you can prove to the bank that the company you want to buy has strong cash flow, belongs to a stable industry, and is making steady profits, that is. That way, you can buy 5 different companies, hedging your risks. Now, you manage them. If they're all toy store chains, you start making money. You could consolidate accounting, bookkeeping, marketing, and other departments under one roof to lower costs across the board, helping to boost the enterprise value. Or you can go the sinister route so angry people on the internet keep waffling about and just gut these companies, lay off mass amounts of people, and essentially turn into the house flipper of business in order to generate returns for you and your investors. You don't even need to be clever though. or ruthless for that matter. In the case of a leveraged buyout, you could theoretically just use company profits to pay down the loan you got to buy the company, and then sell it at a similar price later down the line like you would a home. You'd still make a shed load of money just doing that. At the end of the day, as the owner, you can tell these firms' CEO to do whatever the hell you want, and if they don't, you can just fire them and get new ones. Whatever the tactic, after a while these reorganized firms should be worth more than what you paid for them, and you can sell them for a fat profit. And the best part is, whatever profit share you generate is a capital gain and subject to a much lower tax rate. In the US, for instance, it can only be taxed at a maximum of 20% versus the 40-odd% you'd pay if it were income tax. This loophole is known as the carried interest loophole. And if you decide not to go down the selling route, you can take the company public through an IPO and sell shares to the general public. Whatever the tactic, the point is you very well could be and should be swimming in cash. This tends to be how people multiply their money, and private equity gets its rep for being a brutal business that guts your childhood favorite company like Toys R Us. Different types of private equity funds operate in different ways. This is just buyout funds, and they're all willing to make money whatever way they can and serve as a very useful utility to many people. So let's go over some of the other types. Some firms might take investor money and invest it in gaining a stake in multiple startups in the hope that some succeed and give the firm a payday. These types of private equity firms are known as venture capital firms, and they're just another type of private equity firm. There's also a type of firm called a fund of funds, which, exactly as it sounds, invests its money into other private equity firms. There are growth equity firms, which are very similar to venture capital firms in the sense that they invest in other firms in exchange for a share, but they tend to be much less speculative and will always try and do their homework to make sure the firms they're investing in are already profitable, have a high valuation, lower debt, and are somewhat established. Real estate private equity, as it sounds, invests in real estate. These funds use different strategies from one another. Some go for lower risk, stable rental properties in order to gain predictable, reliable income, and some invest in land or development deals in order to have a chance at higher potential returns at a far greater risk. Infrastructure funds invest in essential sectors like utilities, transportation, social infrastructure, energy, and renewable energy. Secondary funds buy investments and positions from other investors and PE firms who can't yet forfeit their positions from the firm as it's before the harvesting period. The harvesting period is the final stage of a private equity firm. Typically, private equity funds don't last forever. They're not supposed to last forever. They have an initial duration of around 10 to 12 years. The initial stage is known as the fundraising stage, a 12-month period where the firm seeks to source as much cash as they can. They then enter the investment stage where, you guessed it, they make investments in the different companies. Next up is the portfolio management stage, where the fund implements the management and efficiency changes we've already discussed in order to grow the company and enterprise value. Once all that growth has been completed and the investments have grown, there's the exit stage, where we contact our friends in investment banking, sell our positions either through IPO or exit sales to another entity or investor, and we enjoy our money. The ultimate takeaway is that private equity firms come in all sorts of shapes and sizes and operate in different ways. Some of them rightfully hold their terrible reputations of gutting companies and adding no value to the corporate world, but others, like VC firms, have been the lifeblood of numerous companies and startups that provide services we all know and love to this day. If you loved this episode of Business Capped, be sure to like the video so the YouTube algorithm can do its thing and I can keep making more informative videos like this. Comment what you want to see a video on next time and subscribe if you want to see more videos like this one. This was Business Capped. God bless you and good night.